Research areas include capital markets, international relations, corporate finance, financial economics, and international finance. He has been part of editorial board and invited reviewers in many reputed journals such as Journal of Sustainable Finance Investment, Journal of Prospective Financing and Regional Development, International Journal of Asian Social Science, Journal of Applied Finance, Academic Research Journal of Finance, etc. Many of his research work that has been published with reputed journals which indexed in ABDC category Scopus, Web of Science, SCI such as Journal of Business Economics and Management, Scientific Annals of Economics and Business, Annals of Economic Review, Mathematical Applications in Science and Mechanics, International Journal of Economics and Statistics, etc., along with national and international authors. He has presented his research work to many national and international conferences, which also include several prestigious European and American conferences, including Harvard conferences, Boston, USA. He holds membership with Indian Accounting Association, Finance and Accounting Professional, London, Chartered Financial Analyst Network, New York, USA, etc. At NISM, he teaches in the areas of accounting, finance, and banking to full-time postgraduate students in securities market and PG, PISM, and PGCSM. Sir, I'm handing over the class to you. You may proceed, sir. And we are live on YouTube as well.
Okay, wonderful. Okay, good morning, all the students. I'm just sharing my screen with you all.
Generally, sorry to interrupt, sir. Generally, they reply via chat. I allowed them to unmute and speak. They can speak, sir.
Okay, okay, Ashutosh. Thank you. I believe screen is visible.
Yes, sir. I can see performance measurement of mutual fund investments.
Okay, students. So in this particular unit that we have our certification on NISM Series 5A. So in this regard, we are going to understand how exactly mutual fund is working, and we are going to see some parameter. For example, we are going to see one slide that you can see performance measurement. We are going to understand how exactly risk ratio and other parameter is going to be determined, how to select the fund and scheme. So these are the content that we have planned for this particular session. Before we get into directly understanding the mutual fund, let us discuss some important fundamental concept that how exactly this entire market and scenario came up and how exactly it works. Let us go back in time to understand that how exactly this situation came up. So you all know that the Great Depression, particularly when we are talking about 1930s and such kind of scenario, the entire market was, though Indian market was not developed by then, and rest of the world market were investing heavily into the particular options such as mutual fund and stock market. So by that time, there was a scenario. We are talking about the Western countries. So that time, there was a scenario that people believed that their investment are going to be, result with the movement of prices. And when we talk about India, we were in the freedom fighting and such kind of movement. So in our scenario, our ancestor and maybe grandparents always maintain their money mostly with the fixed deposit in the bank or in the post office or some kind of option, because we never had that many options by that time. Though we never even had a choice. So national saving certificate and other pension schemes, they were the only destination where one keep their money. But over a period of time, when we got independent and when we opted for the industrialization from 1951, after that, more number of institution came of it, such as IDBI and ICICI that came up in 1995, 1955. So after that, when industrialization movement came on the peak, over the period of time when we see the scenario for our stock market, for example, 1980s and 1990s, more number of companies started to register with us. And after that, when the number of company increased, some people who are aware with such kind of scenario, they started diverting their investment and savings from usual fixed deposit and making a post office from to stock market. But some evidence that they have experienced, particularly 1990s post to scam. So those people who burned their hand, they might have decided that this is not the market for them, and they are not at all going to invest in such kind of anxiety investment where your capital is going to show the performance based on the movement of prices. So it means if I'm investing in a stock of 100 rupees, if the stock goes for, let us say, 100 to 57 in that direction, I'm going to have in the profit. On the other hand, if it goes to the other way around, let us say 96, 95, 94, then there is a risk. And there are other reasons that we are going to discuss that why this sector has got so much of information suddenly. And first reason is that the movement of prices. Now look at the two scenario. One scenario where we have a, whatever we earn, we have an option to save money, and whatever we save, we can keep money in savings account. That is one, without doing anything, we can keep it idle. Second, we may opt to invest into the fixed deposit. We can make a different amount of fixed deposit over a period of time. That is also called as a tenure deposit. We can even opt for the national savings certificate and other things that is again going to block the capital. But where the return is, we can expect maybe 6.5% or 7% or 8% maximum. That is the return that we are going to receive at the end of year. On the other hand, when I am much aware with the stock market, and when I'm much aware with the how exactly when I can compare the performance of any particular company, a good company, I can see that last year this particular company was 60 rupees, and this year this company is, let us say, 85 rupees or 90, or let us say 120. It can be any amount. You even know better. So when I compare both the performance, being a common investor, one simple thought came into my mind that in all cases, even if there is a risk, investing in stock market is way better than the investing in the fixed deposit. If at all, my objective is to earn higher return. But actually, what happens that let us say one stock, I'm been observing one stock for quite a time now, and I have decided to finally invest my savings into that stock. And right now, the price of that stock is, let us assume that it is 115 rupees. Everything is perfect. If the price goes in the direction of 200, it means 118, 120, 125, everything is fine. But the problem comes when the price start moves the other way around. And here the problem is that, let us say I have already invested my money when the price was 115 rupees. Now, after a week, when I checked, the price is 107 rupees. That means I'm already in the loss. And after that, I waited for, let us say 10 more days. Now the price is 100 rupees. The way it is going down, and I already see loss on my capital investment. The problem here is that there are no such parameter that after this particular point, the price is not going to fall. So I cannot say that 98 is the last point, and after 98 rupees, the price is not going to fall. No one can assume that. Price may go to 95 rupees, it may go to 92 rupees, it may even go to 85 rupees, it may come to 70 rupees again. So if the price is, let us say, 80 rupees, now the problem for me is that my capital is entirely blocked. If I want to, release my capital, I have to book almost nearly 50 40 to 50% loss, right? And that time I might think that yes, that is the period where I get review on my previous decision, that even if the 7.5% or 6.5% interest is there, but one thing is sure, that my capital is intact. In such scenario, we know that we can raise capital earlier. There were two main part. One is the equity capital, that is called as a own capital, or capital with the ownership. If I hold equity capital of any particular company, that means I owe some part, and wherever company release the dividend, I am going to entitle the dividend. And the price rise is going to consider it as a plus if at all it is a good company, and over a period of time the prices are increased. So one point we have understood, it is called as an equity capital. The other way by which the institution can collect the money is through the debenture. It is called the borrowed capital, right? Debt fund, where they are promising to pay particular amount of interest at the period of time. And when someone is investing in those, they are going to receive the interest at every tenure. And that is the fixed rate of interest. The another one came up is called as a pooled capital. So some expert people came up with the opinion that if being an individual, I am investing into the market, there are, you know, I may be emotional, I may be sentimental, I might come up with the wrong decision and something like that. But what about if how if I invest in same stock market, but through I'm accumulating everyone's money, those who wanted to invest. And since I have a large corpus of funds, I'm now investing into the market. I recruit the highly expert in the market. They do research. They know how, when to exit. They know when to enter. They know the economic scenario. They have the information about the domestic market as well as investor market. So in comparison, being an individual investor, they are more vigilant investor who knows when to enter and when to exit. Being an individual investor, I maybe get emotional and sentimental when I look at the prices and like that. So they came up with the agenda that why not, pool capital from all the investors who need to invest, and we are going to distribute the units instead of shares. Those who are investing, those who are paying us money, they are going to entitled to receive the units, and the prices of the units will then move with the net asset value of my investment. And this concept came up over a period of time and developed as a mutual fund. In the same sequence, so many different category of mutual fund came into market, and so many other companies, institutions, bank came up with their own mutual fund, saying that this is the mutual fund, this is the NAV, this is the open-ended, this is the closed-ended. Different category also came up. So this is how we understood in a brief that how exactly mutual fund scenario developed over a period of time. If we look at the history of last 50 years, we can see the most of the development happened in last 20 years, right? So it does not mean that in 80s and 90s mutual fund were not there. They were there in India, but it were not having that much of high capital corpus. On the other hand, right now, when so many advertisement on the television, and people know now that they can even start investing in mutual fund just with 500 rupees and like that. Even small age student also, those who are in school, started to investing in mutual fund and like that. So the idea is that this is again just one another platform where we can put our money for over a period of time, and we can see the growth when the movement of the NAV is increased. We can see the result in our investment. In our agenda, we are going to start with the performance measurement of mutual fund investment. So I'm not aware whether you all have gone through this content yesterday or not, but I believe that we are going to run this slide. Here we can see some risk factor associated with performance measurement. One is the general risk factor. Second, scheme specific risk factor. Third, risk related to debt funds. Drivers of return and risk in the scheme. Fundamental and technical analysis. Let me find out the pointer. Yeah. Fundamental and technical analysis. Investment style, growth and value. Portfolio building approach. Top-down and bottom-up approach. Factors affecting performance of debt scheme, factors affecting performance of gold bonds, and factors affecting performance of real estate funds. So these are the content that we are going to get into to understand how exactly one need to go through the factors that can help them to determine the performance of mutual fund. Let us start with the first one. The first factor here we can see is general risk factor. General risk factor we can divide into two categories. When we look at the risk, one we can see it is a standard risk factor and second one is a specific risk factor. You can read some description about how exactly standard risk factor or general risk factor can be evaluated. So the first point says that investment in mutual fund units involves investment risks such as trading volumes, settlement risk, liquidity risk, default risk, and including possible loss on of principal. Principal, that means the capital that being invested in particular fund. Look at the second point. Second point says that the past performance of the superior or AMC asset management institution mutual fund does not guarantee the future performance. So whenever you see any mutual fund, you can find out that in, let us say, they can say that in 21 they have declared XYZ dividend, 22 this dividend, 23 this dividend. So it does not mean that in 2025, if someone is thinking to invest, there is no guarantee that they are going to receive maybe it's the same return or something like that. However, it still gives the idea to investors that what are the average return, because the return in the mutual fund depends the people who are actually administering the entire investment portfolio. If they are good in decision making, if they can enter at the right point at particular investing decision, and they know when they know that this is the right time to even exit from any particular fund. So in these cases, what is going to happen? They are going to have a better performance compared to the other mutual fund industries. Then the name of scheme does not in any manner indicate either the quality of the scheme or its future prospect and return. So let it be the any name, let it be the any company, it has no association with how exactly they are going to perform next year. The sponsor are not responsible or liable in case of any loss resulting from operation of scheme beyond the initial contribution made by and towards setting up the mutual fund. So this is how we can identify as a standard risk, and you can see the factors that is here described to understand the standard risk are also very normal factor. That is the reason this got named as a general risk factor. Look at the other risk factor: liquidity risk, interest rate risk, reinvestment risk, political risk, economic risk, foreign currency risk, and risk associated with transaction in units through stock exchanges. Liquidity investment that associated with any particular scheme that is restricted strictly with the trading volumes. The settlement period between one time and second time, third is a transfer procedure, right? Second, although investment universe constitutes securities that will have higher market liquidity, there is a possibility of market liquidity could get impacted on account of company sector, general market related events, and that could be other price impact. So the another problem here is that if any particular company immediately comes into news and events, suddenly we are going to see the exponential movement in the trading activity. The volume is going to increase. The moment volume increases, what happen? It also increases the volatility. Now, higher fluctuation in volatility, that means you are going to see that prices are moving very fast, and it makes very difficult for someone to take the decision that should I hold it, should I buy it, or if I have already brought it, whether I sell it or not. Right. So such kind of a trend we are going to see when there is a sudden change in the uh, trading activity, and it depends on the event and news associated with the company. Moreover, if it is not associated directly with the company, but if it is associated with the sector, we still can see that kind of scenario and that kind of movement into the price action. Interest rate risk, right? Look at this description. Fixed income securities such as government bond, corporate bonds, money market instrument, and derivative that run price risk or interest rate risk. Generally, when interest rate rise, prices of existing fixed income securities fall, and when interest rate drop, such prices increases. The extent of fall or rise in the prices depends upon the coupon and maturity of the security, and also on yield level at which the security is being traded. Here, I believe that first and second point, I'm sure you are aware. When the interest rate increases in the market, it is going to have a negative impact on the prices. Not only that, when we see that the one thing that you may refer here is any prices which is being offered, prices and the yield on the long-term bonds and short-term bonds. So once upon a time, there was a great economic theory, and it is being in a practice since a long time. So the theory says that there is an inverse relationship between the prices of bonds and the yield which are being offered on the bonds. So it means that if the bond price increases over a period of time, it is going to have a contrast impact on the yield. So the yield is going to decrease. On the other hand, if the yield is increasing, the price of bond is going to decrease. So once upon a time, some economics all over the world, they consider this as a parameter to understand whether the economy is developing, economy is at the same point or constant, or it is going down. So to determine the economic scenario, they used to use this as a strongest parameter to identify that whether what is the scenario, and for that they used to consider just simple two things: the long-term yield prices. So the theory says that in case the short-term yield inverts with the long-term yield, it means that the price of 25-year bond, interest rate on 25-year bond, let us say it is 3%, and the interest rate on, let us say, 2-year bond, if it is 3.5%, if there is a closer distance between these two, that means the economy is in danger. And when the short-term yield inverts with the long-term yield, the economic used to say confidently that this economy is going to collapse, right? So this is how the interest rate once upon a time considered. And I believe that with this explanation, you would have now better idea. Further, any investment which made in any particular scheme is again strongly bound to the reinvestment risk. Being an individual investor, what usually happen if I am investing in a stock where stock prices, let us say I have invested 3,000 rupees and the price of that particular stock is 16 rupees. Now, I have seen the price move to 18 rupees or 19 rupees, but I didn't sold. I thought it is going to get increased, right? Because this is how ordinary investor look into. And after that price again came to 16 rupees and then it came to 15 rupees, then it is 14 rupees, then it is 13 rupees. And I can see the price is 13 rupees for quite a time now. And it is not going down, not going up. I'm going to get idea that why not I make average of my price. So I invested more 2000 rupees. And the idea behind investing 2000 rupees more is I'm going to reduce my average price. So since I have brought in 16 rupees plus I have additionally paid brokerage and other charges, you know it well. But now I have idea that if I invest 2000 rupees now, since I'm a long-term investor, so what is going to happen? I'm going to create an average. 1 second. Now from 13 rupees, the price again came to 14 rupees and 50 paisa. But I am not again selling again because since I said myself that I am a long-term investor at the time of investing 2000 rupees more. Now something happened in the economy or nothing happened, but price came again down to 12 rupees, 11 rupees. Now I am left over only with 5000 rupees more. And I thought that this is the best time. I am getting this stock just in 11 rupees right now. And if I invest 5000 rupees now, my average is going to drastically come down. I reinvested 5000 rupees, right? And once I reinvested that 5000 rupees, the price came to 12 rupees. But after that price again came to 9 rupees. And then it came to 8 rupees. Now see the scenario that I know even if price is 8 rupees, it is going to go up because I did my research on that stock. I know that the stock is going to respond sooner or later. And since I am a long-term investor, this is the best opportunity for me to, invest whatever I have. But the issue is that I have already invested, right? This is one concept we understood, but if you look at the other parameter, I'm merely loss of almost 50% prices that I have invested first. So this is the scenario where you can understand that what is the reinvestment risk and how deeply it is associated, right? So for reinvestment in anything, you have to go through several factors, and it is not that easy that you just look at the price movement, you look at the movement of index, and you can come up with the decision. It accounts several other factor when we understand the reinvestment. So here the explanation says that this risk refers to interest rate levels at which cash flow received from the securities in the scheme are reinvested. In additional income from reinvestment in the interest on interest, this is considered as a component, right? It is called as a interest on interest. The risk that the rate at which interim cash flow can be reinvested may be lower than that originally assumed. So this is the general scenario. It is always lower because then only reinvestment appears. The next is political risk, right? Any political movement, or maybe you have seen the market at the time of election or such kind of event. We know that it is going to have some response of that particular event. There is one method, very simple method, maybe several template also available on uh, Google and other platform. The name of method is event study. So on that template, you are going to find the Excel format. You just need to give an input of you just derive the prices. So what happens in this method, in this event study? They consider any particular event that is going to come up. Let us say you can refer any past event, let us say last election or maybe previous election or something like that. What you do, you derive the prices 1 month before that particular election and 1 month after the election. And in the middle, you can write down the event date. That means the election or whatever event you wanted to study. Even you can study company prices also. But in this explanation, when I'm giving, I'm considering the Nifty index. So when you compare the prices and when you put the event in the middle, you can just map out the volatility with the simple function to determine the volatility. You just calculate the return, yesterday's volatility divided by today's volatility, and based on that, you are going to find out what is the return multiplied by the today's volatility. So this is how you can find the daily return on particular stock. And based on that, when you have compared the performance before the event and after the event, you can exactly determine that how much impact of such kind of political news or let it be any event on the market. If you wanted to come up with the such kind of event for any particular stock, you can take up the stock exactly 1 month before and take 1 month after. And let it be any dividend decision. Let us say one company has announced that they are going to declare dividend on so and so date. You look at consider the prices. And the best practice is that first, sometimes what happens that impact is differ from sector to sector. So you may see, let us say five company, all five are from different sector. One company is from energy sector, one company is from FMCG sector, one company is from, let us say, banking sector, financial services sector. So assume that five companies from different five sector announce the dividend. Not necessary that on all the companies, all the sector, the impact of event is same. It is possible that impact of event is completely different from one particular company's announcement to another company's announcement, if at all they both are related to the different sector. So the best thing is that once you study, and there is a lot of thing that you can come up and understand and learn well when you are exercising such kind of tool to enhance your understanding. So this is how you can determine how particular event, including the political event, impact on the risk associated with the prices. The next is economic event. I have already captured some discussion related to this in the earlier, but you still can go through the explanation what is mentioned here. Sometimes a slowdown in economic growth or any other macroeconomic imbalances, the best thing that this Russia-Ukraine war when announced in February 2022, the best thing you look at the how that has impact on, the best thing you study, you take up the global indices, such as you take up the US market, you take up the European market, then you can take up the Asian market. You also take up the Indian market and check out that when the war declared, when the Russia has created their, made invasion to the Ukraine, which was the market that has responded the most, right? And whatever market you identify, whatever country you identified, that country would also likely to have the overreaction to such kind of event, right? Once upon a time, this Chinese market, most of this institutional investor used to consider as a gambling market because there was an extreme movement of prices. And if you talk about the 1980s and 90s, Japanese market was leading the world, that was attracting investor from all over the global investor to invest because there was extreme price movement in 80s and 90s in the Japanese stock market. So once you study such kind of scenario, you are going to, unable to understand that how different market respond to different economic growth and macroeconomic event. Then the next one is foreign currency risk. Sometimes the fluctuation of the, currency, that whether our currency remains stronger against the, US dollar, or it is a weaker against the US dollar, strongly impact. And the reason is that sometimes, once upon a time, one student, when I was taking such kind of session for, physical mode, one student raised the question that, sir, how exactly the movement of, let us say, Indian rupees become stronger against the US, how actually it impacts on the market, and how actually it impacts on my stock that I'm invested, and how actually it impacts on the, let us say, on the prices of NAV, if at all I have invested in the, let us say, mutual fund. So then I explained that since most of the company are, which whatever name you see in the Nifty 50 company, are strongly engaged into the global trades, right? That means their most of the revenue, you look at the revenue of the Infosys and look at the revenue of any other companies, look at the revenue of companies that are engaged into the exporting of their product. So when they are exporting the product, that means they are going to demand the money from other country. So if the rupee has become stronger, what is going to happen? Ultimately, their amount is going to be lower in Indian currency. If the rupee has become stronger against the US dollar, what is going to happen? They are going to, let us say, I have made sale of 1 billion or 10 billion US dollar, right? And to any particular country. Now, right now, the rupee price is, let us say, 82 rupees. Consider 80 rupees, right? Now, the price is 80 rupees. I have made the sell for 10 billion US dollar. If the price become 81 rupees or 82 rupees, that means rupee is going to be weaker or stronger. If the price from 80 rupees to become 81 rupees and 82 rupees, that means the rupee is going to be weaker. So when the rupee is going to be weaker, that means I am going to receive without doing additional sale. If the rupee is going to be, weaker, I'm going to receive more revenue. I believe you understand this scenario. On the other end, if the rupee has become, stronger, that means 79 हो गया, 78 हो गया, 76 हो गया, 75 हो गया, that means I'm going to receive less amount in Indian rupees. So without doing anything, my revenue is going to be, expected revenue is going to result into the losses, right? So that is the reason one need to consider how exactly the fluctuation in the foreign currency risk, right? And the last one, in respect of the transaction in unit of the scheme through stock exchanges, the allotment and the reduction of unit on any business day will depend on the order processing and settlement. This happens through BSE and NSE in the respective clearing corporation on which the fund has no control. Other specific risk factor here we can see that this volatility part we have already captured, right? Let us skip this. Yeah. Other specific risk factor that you need to keep in mind is risk associated with this short selling and the stock lending. Short selling, that means one is selling the stock into the live market even if they are not holding it, with the assumption that very soon the stock is going to fall. That means the people or the investor who are resulting into the short selling, they have information that in a some due course, the price is going to fall, right? So that is how they result into the short selling. Price associated with the mid cap and small cap companies, right? The companies which has a turnover between 2000 rupees to 5000 rupees is considered as a mid cap companies, and 5000 to 20,000 market cap is called as a large cap companies, and any amount lower than 2000 crore considered as a small cap companies. So the reason that this sector have defined separately that this is the mid cap company, this is the large cap, and this is the small cap, the main idea behind such kind of segregation is the movement of prices. You might have seen that the prices of companies, which is let us say 7 rupees, 8 rupees, 5 rupees, many companies are there, right? I'm sure you are aware with that. So the price movement in such kind of companies from 6 rupees to 9 rupees and 10 rupees is very common. But when I say that the from 6 rupees to 10 rupees, that means almost more than 60% price movement, right? We never find such kind of price movement in the large cap stock, right? So let us say if the stock is 3000 rupees, we do not see the movement of 3000 rupees to 5000 and 5500 rupees in a week or something like that. We don't usually see. So this is the reason that they have came up with the segregation that when you are investing in the small cap companies, the price volatility you can expect much higher. In the mid cap, you can see the average movement of prices, and in the large cap, the price movement are going to be slower. Next, risks associated with the dividend, and sometimes there is no guarantee that company is going to declare the dividend, though they have a profit, right? And sometimes they reserve that profit instead, rather distributing the profit as a dividend, right? Risk associated with the derivative. Derivative are, we can say, the contract instrument that has strong association with the underlying asset, and further the strong association with the expiry. So these two factors are so strong that it is going to have a extreme pressure on the movement of prices. So earlier, a derivative considered as a hedge instrument. Let us say if I'm a mutual fund investor and I'm the portfolio administrator, that means consider me that person as myself who is actually investing entire 2000, 5000, 10,000 crore in a stock, and so when I'm investing, let us say 10,000 crore rupees in one particular company, what I'm going to do, I'm also going to invest 200, 500 crore rupees into the put instrument. So the idea is that in case the price comes down, whatever price it is, if it comes down, yes, it is true that I'm going to have a relative loss in my demat account. But on the other hand, the put option that I have purchased is going to compensate my losses. So that was the main agenda about the derivative. But what happened that over a period of time, people used derivative as a trading instrument. They considered them as a stock and like that. So this has increased the volume and premiums of the derivative, which ultimately result into the high risk, right? So this is the one factor. Risk related to the debt funds. If the debt fund are going to, let us say, increase the interest, what is going to happen? It is going to diversify institutional investment from equity market to the debt market, right? So this is also one risk. Risk associated with floating rate securities, the securities which has a floating rate mechanism, it has relatively higher risk than the fixed rate. Factors associated with repo transaction in the corporate bonds, right? Repo transaction, that means when Reserve Bank of India and the other commercial bank exchanges the money, when commercial bank is going to borrow the money from the Reserve Bank of India, and when they are returning the money to Reserve Bank of India, they lend their park their money for over a period of time, considered as a repo rate and reverse repo rate. It defines that how exactly market scenario is going to be into the banking sector over a period of time. Next is risk associated with creation of segregated portfolio. Usually what happens that investor, let us say you yourself investing some money and you are the sole decision maker for the investment, whatever you make in the market. So what you do whenever you create the investment portfolio, let us say you have a 3,000 rupees. So you are selecting different stocks at the portfolio. You may consider at least one stock of banking sector, maybe one stock of a financial institution, one stock of energy sector, right? So what you are doing, you are creating diversified portfolio. But instead of that, what you are doing, you are focusing only on one sector. Let us say you are investing in FMCG company. So you have purchased one stock of one FMCG company, second stock of second FMCG company, right? So this is the example that when mutual fund does such kind of scenario to create their portfolio, there is a risk when they are creating portfolio for particular segregated portfolio for one particular sector. The next one is risk associated with investment in securitized assets. Securitized asset, that means what happened that all this bank and financial institution, what exactly they do in practice, that whatever lending they have done to all the parties, right? They securitize entire lending, and once they securitize, they are in a position to sell out the entire portfolio to any other bank, other commercial bank, or other institution, and it is then traded as a one asset itself, right? Even it can be retraded as well. So here the point that we are referring right now, in case the mutual fund also have invested and they have securitized the asset, there is a still risk associated. It is possible that if I'm managing the portfolio and if someone else managing the portfolio, you can ultimately see the difference, right? That it depends on person's expertise, that how well they are managing the portfolio by looking at the market scenario. And last one is risk factor associated with investment in REITs and InvITs. REITs, that means oh, my voice is not audible. Am I audible now?
Yes,
Yes,
sir,
sir.
you're audible, sir.
Oh, okay. I just received this message that my voice is not okay. So REITs, that means when institution or particular mutual fund started to invest into the other sectors, let us say real estate and such kind of sectors, then what is it is identified as a REITs and InvITs. This is the explanation of the points that we have already gone through, so I'm just skipping it. All this part is again available on our on the document that is freely available on our NISM website. That you just need to register and you can download entire material about this mutual fund. Now this point elaborates factors that affect mutual fund performance. So here 2 points we need to consider. One is the difference between market risk and systematic risk and company specific risk. And second, mutual fund investment are subject to market risk. So this is one factor that is well known by everyone, but they also do have a little understanding that market risk, that means the risk of movement of prices and indices, right? When we look at the live market. Look at some drivers that is associated with risk in any particular scheme. So the one we need to consider, equity is an asset class that represents growth in investment. So this we are talking about the any equity issued by any company, right? It means that if I'm issuing, I'm doing one particular business and now I'm doing so well. Someone suggested me, why not registered as a SMEs, and then you can register into the stock exchange. You can list your company. So I have completed the procedure. I came up with the IPO, and now my company is listed on the National Stock Exchange as well as the Bombay Stock Exchange. Now, whatever I do, how well my company is going to perform is now going to be responded by the prices of my particular company. That is even beneficial to me as well, because if the price of my share are going to rise up, it also increases my overall market capitalization, right? And if my company is not doing good, or maybe not consecutively profits, or not generating profit, then the price are going to go other way around. Right? Even the if I tied up, let us say, any particular international deal or a large deal or a contract that I have secured, which has a large amount, it is then going to be responded by my prices, right? So that is the reason the first sentence says that equity indicates it is a asset class and that represent growth investment. Second, the returns to an investor are primarily from appreciation in the value of the asset, right? So if my shareholder who purchase my stock is going to get benefit if I come up with the positive news in the market, they are going to be the direct beneficiaries. Next, the risk to the investors arises from the absence of defined and fixed return from this investment, which can be volatile from one period to another period. Let us understand fundamental and technical analysis. Now, one general statement you can read in the first part, that mutual fund are not permitted to promise any returns, right? Unless it is an assured return scheme. Assured return scheme call for a guarantor who is named in the SID. And second, the guarantor will need to write out a check if the scheme is otherwise not able to pay the assured return. I believe that whatever advertisement so far you came across related to the mutual fund, no mutual fund guarantees that if you invest in such kind of fund, we can promise you 20% return or 25% return, and we can give you check right now. I'm sure you have not came across such kind of thing. And the part here that you can see as a fundamental and technical analysis. So fundamental analysis, that means the analysis that you perform considering the raw performance data of any particular company. Let us say you take a look into profit and loss account, you take a look into the, other trading activity, you can take a look into the balance sheet changes, that you just give a peek that what company has done in the last year, whether they have increased the short-term borrowing, long-term borrowing, they have returned the borrowing, they have reduced the borrowing, right? And look at the cash flow, that what is the movement of cash inflow and cash outflow. Maybe then you can apply some of the important ratio to determine that what is the profitability, right? And you use the ratio and you use the further analysis considering the raw statements. So everything you perform on such document is going to be part of fundamental analysis. On the other hand, some people, they believe that price has one particular strong measurement which can be identified through its movement pattern. So what they do, they consider the price, they look at the movement pattern, and when they see that after one particular point the prices tend to go into the upper side, they decide that this is the resistance level and this is the support level. This is how they came up with. There are so many advanced tools so far right now, and there are so many software they can which you can use to come up with the technical analysis. So many different methods, starting with the regression analysis to very high advanced method up to the neural network application and like that. So using such kind of methodology, one can decide that okay, these are the hidden fact in the price action and these are the scenarios, so we can expect, we can forecast this kind of prices. So whatever decision we come up using those factor called as a technical analysis. Some parameter, the parameter that you can see are very much generalized parameter, which are the parameter which is maximum considered to evaluate the performance. So one is EPS, earning per share, right? How one can find it out? So very simple method. Operating profit you need to consider here, right? Or net profit after tax, PAT also you can consider profit after tax, divided by number of equity shares. So using this simple formula, you can determine earning per share. Please remember that earning per share, whatever it is, it has no relevance whether the company is going to declare dividend or not. Second, P ratio, also known as a price to earning ratio. Again, simple formula, market price per share divided by EPS, and you can quickly find out what is the P ratio of one particular company. Next is PEG ratio, price earning to growth ratio, right? So it relates to P ratio to the growth estimate in the company's earning. A P ratio is the one indicates that the market has fairly valued the company's shares given its expected growth in earnings. Then the next one is book value per share. Again, simple formula. You just take the net worth of the company divided by number of outstanding shares. That means how many, whatever number is of shares are being issued, you have to consider that entire number. And looking at the book value, when you evaluate any company's book value, it gives you the idea, it is an indicator that how much each share, whatever is issued, is worth, right? As per company's own book of account. And next, last one is dividend yield, right? That means dividend per share, whatever is declared, divided by market per price per share. So when you just consider this kind of division, you if the company has declared the dividend, you just take out that what is the dividend per share is declared. Let us say 10 rupees dividend or 15 rupees dividend declared per share by any company. You just divide it with the market price per share. So when you do it, you are going to measure the payout that is received from the company in percentage for each rupee of investment in the share. Right? There are two investment styles. One is the growth investment style, and second was is the value investing style. Right? Growth investing style, that means it is going to be invested into the high growth stocks, stock of the companies that are ready to grow much faster than the market. So when you are investing into, when you wanted to pick up the companies, assume that you yourself cleared all this examination and you become the portfolio manager for any particular mutual fund. When you are given object to invest in a growth funds, what you are going to do, you just simply need to pick up the companies of small cap and mid cap that we have discussed earlier, because these are the only companies, small cap and mid caps, where you can expect relatively high growth, right, of the prices. So let us say one company stock price is 4 rupees or 3 rupees, something like that. On the other hand, there is a one company where the price is, let us say, 1600 rupees or 1700 rupees for one equity share, right? Both are listed companies, both are listed into the NSE and BSE, both the stock exchange. Now, assume that one strong super news arrived in the market related to a company which has a 3 rupees and 4 rupees price. You can expect that 4 rupees can go to, let us say, 6 rupees, 10 rupees, 12 rupees, 15 rupees. You can understand that such kind of movement is considered as a very normal when we, look at those prices, 3 rupees and 4 rupees. On the other hand, the companies which has already 1700 rupees price, even if the news is stronger, you can expect maybe 10% movement or maybe maximum 20% movement immediately on those prices, right? Maybe you can have, shock on the other day, maybe 10% more on the next day. But after one point, the price, when it reaches to, let us say, 2000 rupees or 2100 rupees, you won't find extreme movement then after. So if I compare the price rise of, let us say, 400 rupees or 500 rupees from the original level, I can say that 500 rupees is not even a one third of the price of the company. So if we assume that the price of company is 1700, then 500 not is even a one third, right? You can see it is hardly 26, 27 percentage movement. On the other hand, the price which is a 3 rupees and 4 rupees can go to 16 rupees and 17 rupees. That means almost 400 times return we can expect. So this example I am providing you to directly relate this point. When you have to make a, investment into the growth investment style, the pickup is going to be from such kind of sector. In case of value investment, some stock where you might have noticed that the beta value is relatively lower, right? Now, beta value is one factor that investor and researcher consider to determine that what kind of movement we can expect when there is a movement into the market. So when the beta value is lower, when I have just mentioned, it means that if market is increased by 100 points, it is not necessary that same kind of movement we can appear into stock. So let us say if the beta value is 70%, we can say that even if the market increased by 100 points, there is likely to hardly up to 70% maximum reaction on this particular company's price, right? So this is how we can evaluate. So when you wanted to go with the value investing style, you need to determine the stock which has the lower beta value and higher market capitalization. That means you need to select it from the large cap. So what happened when you are investing into the value stock? That means you have just, secured your yearly dividend. Look at the companies such as ITC or Nestle. So every year they pay promising dividend to their investor, and little bit growth in the prices over a period of time is going to consider as a plus. So this two example can help you to understand that how this actual two plan of style of investing differs with one to another. Before we go further, I would like to take a break for 5 minutes, and after 5 minutes, we are going to restart. Okay, welcome back, students. We can start now. Before the break, we were discussing about the two investment style. One identified as a growth investment. Second, we can identify it as a value investment. And we, with the example, we understood that how this investing style makes difference with the purpose. So this entirely defines with the purpose that what is the purpose of investment you are making. And in all investing activity, maybe you are at very young age at this point of time. So you might have a different purpose that if you are in school or college, you might have planned to go to different countries for the higher studies. Maybe after that, when you get a good job, then you wanted to purchase a car. Maybe after a your own house. So, and after that, you might make a plan for, your children, their education. So this is how a person may have a different purpose, and each purpose has a time duration, each purpose is a goal. So accordingly, one can decide that how exactly they need to make and structure their savings that can come up with the result to meet up the purpose. Next is portfolio building approach. There are two approaches that is well known. One is called as a top-down approach and second is called as a bottom-up approach. In the top-down approach, we can see the portfolio manager evaluates the impact of economic factors first and narrow down the industries that are suitable for investment. And after companies are analyzed and good stock within this factor are going to be identified for the investment. So this is the top-down approach. Look at the bottom-up approach. It is the approach where analysis of the company and specific factor considered as a first. That means I already know that which company I'm going to invest, right? I don't need any other things to determine that which company I'm going to invest. I already know that. And after selecting the company, they evaluate the industry factor, right? They are going to find out that, okay, these are the factors that I need to consider. I need to look at the economic scenario. Everything is peaceful at the global level or not, or someone is, shooting up any missile on other country or something like that. So I'm going to then consider the, such kind of factor to evaluate the idea. Now, to understand this better, let us look at the example that all the fresh investor, those who do not know anything about the stock market on a first place, and they are learning, they are educating themselves over a period of time. Every day they are gathering more information that, okay, these are the 50 companies which shows the parameter of the market. These are the 30 companies which shows the parameter of the market on the Bombay Stock Exchange and National Stock Exchange, and these companies are belong to this particular sector. This is the weight of the company. Now, the very important question here that which method is considered as a good. So it depends on objective. It depends on the mutual fund industries. It depends on the portfolio manager who are actually operating this kind of scenario. There are several tools and economic metric method that we have discussed little bit earlier. So what usually can be considered as a wise practice is I give you example. You take all the different sector that we have here in our country. Let us say energy sector, pharmaceutical sector, then petrochemical sector, FMCG sector, right? Banking sector, financial services sector. What you do, you take all the indices of this sector, and then you can take GDP on the other hand as another variable. You take the historical data for 5 year and 10 year or such kind of period, and once you put up into the software, then there are several methods that you can perform to determine and assess that what exactly are the sector that performs the most when there is a growth in the GDP. So let us say GDP is 6.5%, and from 6.5% to it approach to 7.5%. When we give input of all the indices, including the Nifty 50 index, we would be able to determine the exact indices which captures the most response, right? And you can even vice versa check out the impact that what is the movement in the Nifty if that particular sectors performs well, right? So one method you can note it down is called as a vector autoregression. Once you use vector autoregression, you would be able to assess the vice versa impact, and then you can even go with the Granger causality. That is another test that you can apply. So when you apply this test, you would be able to determine that, let us say, if one particular sector, assume that FMCG sector, you identified as the most impacting sector if the GDP is increased from 6.5% to 7.5%, it is the let us say uh, banking and financial sector which impacts the most. Now you also consider, after when you apply the Granger's causality, you would be able to identify that if there is a growth in this particular sector, how much it again impacts on the GDP. So you can actually measure that if GDP increase 1%, what is the contribution by this sector, banking and financial sector, to that 1%. This is one exercise that you can do on a first place. After that, what you can do, you can even determine the exact company out of that list of entire banking sector. You can determine the exact company, that which is that company which has the most influence in the moment of this particular index at all. So when you do this type of exercise, you would be able to identify the exact company that you are being looking for the investment. So this is called as a top-down approach. In the bottom approach, we already have information and news. We know that, let us say, this particular sector is going to boost up very quickly in, no time. So we are just waiting for the right economic scenario. We are ready with everything. We are just waiting for the right economic scenario and the right price band to get into the company, right? So this is called as a bottom-up approach. The factors affecting performance of debt scheme. So there are two impacting schemes. One is the interest risk and second is a credit risk. Right? We already understood the interest risk. Credit risk, that means there are likely of chances that the amount or the investment are not going to generate the capitalization over a period, and on the other way it is going to go down. So when we see that there is a loss of reducing the capital, or such kind of scenario is called as a credit risk, right? Mostly credit risk factor is largely impacted into the banking sector. So it considered as when lending is going to be made to any third parties as a loan, and the chances or recovery of that loan, let us say if it is 100%, we can say that there is an optimum credit risk. But if chances of recovery is, let us say, 90% or 80%, we can say that there is a high credit risk. Second, the yield on debt securities tend to move up as the maturity increases, right? This also we have understood. Next is factor affecting performance of gold funds. So first thing, gold funds, that means the funds which are largely invested into the gold, right? And related instruments. So that is the reason when you compare the gold prices during the COVID period, you can see that it has a sharp uptrend. Not only that, other precious metal like silver also responded during the COVID period. So that is the reason once upon a time it is considered as a safe haven, and it is also the destination for, the most popular destination to for the hedge practices for most of the international uh, investors, right? We can see the fluctuation and volatility into the gold prices when there is a political or economic turmoil, right? We know that the gold price are going to shoot up. Second is strength of the rupee. Economic research into inflation and foreign currency flows help to analyze. Analysts anticipate the likely trend of foreign currency notes, right? There are again several methods that we have understood during the discussion of technical analysis. For REITs, it is considered as an economic scenario, infrastructure development growth. Even you can consider the what are the pace of infrastructure growth at the different cities, different regions, right? And overall growth. So you can compare it, and the interest rate. Interest rate shows that whether the money that is being borrowed is costly or if it is a cheap money. So these are the part that I could cover up in this performance measurement of mutual fund and investment. There are some questions that we can discuss here. Let me open this chat box. Right. Sir, I'm in the session. Okay, class. Yeah. So the first question here is you can respond in the chat box here. The first, I'm just showing you the first question. Look at this question. Let me put this chat box here. What are the two broad categories of risk mentioned in the scheme information? Yeah, I have started receiving the answer. I think the first answer I received from Parth. I think Parth is the one who provided the first answer. He says that D is the correct answer. Let us see. Yeah, we received more answer also. Manish also responded just now, right? And I can see Kanishka also responded. Anand responded, right? Nitin Saini responded. Anubhavi responded, right? So most of the students responded the D answer, right? Only Manish has said the A answer. Let us see, we receive more response. I think Govada also responded. Vaswant, oh, Priyanshi. I think we see more response now. I'm so happy to see that you are now, responding well. Right. Oh, another answer we received. Ruvia is also agreed with A, and Samyak is also saying C. Right. Let us look at the answer for this question. Oh, finally answer came up D, right? And the answer is A. General risk factor and specific risk rate factor. You see, this was the first point that we have started our discussion, and hardly how many? One, two, and earlier one, only three answer got correct. So Ruva was absolutely correct, Samyak correct, and earlier also one A respond we have noted. Who provided? Yeah, Manish. Manish has provided the first answer, correct answer. And the reason is that you look carefully, right? We are not discussing about the type of risk. You look, we are discussing about the broad category of risk mentioned in the scheme information document. We are talking about exclusively SID, scheme information document. So scheme information document provides only two factor. One is a general risk factor and second is a specific risk factor. Right. So therefore the answer here is first. But I'm so happy to see a lot of response. Let us see how you are doing in second question. Now take your time, but it is okay you respond later late, but you should come up with the right answer. So let us see who respond first here. Okay, first response we received from the Parth. Oh, we see many responses here now. Only Parth and Manish and Nitin. I think some students are still reviewing it. You take your time. Satyam responded. Nitin already responded. Yashwant responded. Right. Yashwant said it is all of three. Right. And Ashish says it is the high market volatility. So the question here, look at the question. What is the primary reason for the occurrence of liquidity risk in mutual fund investment? Right. The question says, what are the primary reason for the occurrence of liquidity risk? So liquidity risk arise definitely with the change in the trading volume. So A is definitely is going to be the answer. When the trading volume increases, we understood that the market volatility too increases. You remember? I hope you recall that when the trading volume increases, it also increases the market volatility. And when there is a lack of well-developed secondary market, we can see there are even higher response of the same event. So therefore, we can say here the answer is all of above, right? Even with this two first answer, we can determine that answer cannot be the just one option, because when trading volume, there is a change in the trading volume, let us say very low trading volume to high trading volume. We understood with the example that it also impacts on the volatility. And when volatility is increases, what happens? We see higher fluctuation in the price movement. Now this question says, sir, option 2 is confusing. So can you elaborate it? Oh, okay. You want me to elaborate second option? High market volatility. This will, I hope you recall, Partha, I hope you were there when I was discussing about when there is a news or event immediately came up about company, and before that there is a no trading volume. So when trading volume is not there, what is going to happen? Even if you want to buy and even if prices are there, but there is no one to sell those stock. So if at all you wanted to buy, what do you need to do? You need to pay the premium prices to buy the same stock. But when news or event happens in that company, what happened? There is a sudden change into the trading volumes. And when there is a rapid change in the trading volume, it is going to create the high volatility in that particular stock only, which again associated with the volatility of the index. So this is how ultimately these two things together makes extreme fluctuation in the prices. So it means when you are seeing prices, let us say 16 rupees or 17 rupees right now, in a very few moment you can see it is 18 rupees or 19 rupees or 21 rupees, something like that, right? So that is called as a high market volatility. There is a parameter for volatility index VIX that you can refer to determine the market volatility. Okay, let us go to this question number 3. Let us see how you respond here. Read the question carefully, read the option carefully, and then you submit your answer. So far, I have received no answer. What is the impact of interest rate change? Oh, so many answers I am coming at the same time. I think Samyak is the first, Chavi is there, second, Partha, Manish, Yashwant is also responded, Kuvada. Okay, so the question is, what is the impact of interest rate changes on the prices of fixed income securities? So first option is price rise when interest rate rise. We understood that there is no direct relationship. So when we see that the price rise when the interest rate rise, that means there is a direct relationship. But when we refer to the illustration and example, when we discuss about the interest rate changes, We know that this is not the correct one. Second, price fall when interest rate rises. Yes, because there is an inverse relationship. I'm sure you remember that we also discussed into the long-term bond and short-term prices, short-term bond prices to understand that how is the relationship between the price of bond and the yield which is being offered by the bond. C options, prices are not affected by interest rate change. So we know there is a straight incorrect answer, right? Again, option number A and option number B cannot go at the same time because both are contract options. So option number D is also absolutely incorrect option. Now the option remains between option A and option B. Option A says the direct relationship between the price rise and the interest rate, and option B says the contrast relationship. Can anyone say which one is the correct option? I think last response by Manish Kumar, right? Manish Kumar. Okay, that is the only last response. So the correct option is A and B. But this, even if in this slide, you can see it is A and B. This cannot be correct. This is itself is a wrong answer, right? Even if you see that it shows in the slide, but this is not the correct answer. Correct answer is B only. And we know that B is only correct answer because there is a contrast relationship between the price and the interest rate. So when the interest rate increases, price fall, and when, yes, correct. Then part says, sir, but in case of existing security, there is inverse relationship. Existing security. No, in no situation, this both option cannot. I agree with you, Parth, but you look at this two option A and option B, they cannot go together. You look at the option, you know, both are a contrast options. So how we can say that the contrast option can be, come at the same time? So here correct answer is B only. So those who have submitted B answer have responded with the correct answers, right? I think many students have submitted the B answer. Okay, let us go to the next question and consider this tick mark as a typo error only, right? The next one is question number 4. Which of the following risk is specific to investment in foreign security, right? One is a currency risk, right? Second is a credit risk. Third is a interest rate risk. And last one is a liquidity risk. So I think we already received the answer, right? Only few students. I was expecting more response. And now I can see response coming up. And the correct answer here is the currency risk, right? There is no alternate option here. We know that when we are investing into the foreign market, yeah, many answer I can see now. Right. Satyam also said, Yashwant also provided an answer. Okay, yeah, all are correct. The answer is absolutely right. It is currency risk. Question number 5. Now, this question is a little bit challenging. Go through it. Let us see how many can respond correct for this. Which of the following statement about the past performance of the sponsor AMC mutual fund is true? And correct answer, okay. No one has submitted answer so far. I think you are reading right now. Oh, I see answer now, right? Oh, I see answers are coming quickly. I couldn't see it is coming so fast. Right? Samyak said, Ashish, Samyak Partha, Kuvada, Chavi. I think all these people already responded. Huh? Okay. So four options you can see here. It guarantees the future performance of futures scheme. We know that this is not correct. Second, it does not have any bearing on the future performance of the scheme. Third, it is a reliable indicator of the scheme future prospect and return. You know whether this is correct or not. And last one is, it is a good predictor of the scheme's future volatility. So I think last answer is provided by Anand, right? No, Satyam. Satyam said the last answer. The correct answer is B. It does not have any bearing on the future performance of the scheme, right? So no matter whatever performance was in the past, we cannot say it has a relevance on the future. So many B answer, Guvada, Partha, right, is absolutely correct. Samyak, Ashish, no, Ashish says C option, right? No, this is for the earlier question. Okay. And here is the next question. Look at this question. What is the impact of delays or problems in the settlement of transaction on the scheme's asset? And here we see the answer. No. Yeah. Partha give the first answer. It is a D. Right. I think so far only Partha said, oh, many answer came up. A, Chavi says A, Samyak says A, Manish says D. Okay. No one is saying C, huh? You don't agree with the C? Any problem with C? It has no impact on the scheme's performance. Okay, let us see what is the correct answer here. The correct answer here is A. It causes the asset to remain uninvested and earn no returns. Okay, I think many answers we have seen as a correct answer. Now, maybe this is the last question. Let us see how you participate in this. What is the impact of a slowdown in economic growth or macroeconomic imbalances on investment in the country, right? Read the question carefully. Four options. One is it has no impact on investment. Second, it adversely affects investment in the country. Third, it positively impacts the investment in the country. And fourth, it only affects the certain sectors. Oh, so many respond already submitted. I think first response we started from which one? I think Satyam has responded first. Right? Satyam and Yashwant are fastest here. Nitin is also here. Okay, let us look at the correct answer, and the correct answer is B. I think you have submitted the absolutely correct answer this time, right? So it has adversely effect in investment in the country. Oh, last question we still have. Okay, please quickly go through this question. I think Chavi and Partha said, Manish said, right? Shubham. All have said the answer is B, except Ashish says that it is a A. Even Anubhavi also said it is a B. Priyanshi says B. Okay, Nitin says A. So I think most of the answer are between A and B. Huh? No one is saying C. Even Samir says that it is a A. Okay, Samir. Let us say we are going to check out. See, no one is saying that it can be C or D. So all says that it can be A and B. Even Shubham says B, right? Kuvada again says B. Okay. Shall we check the answer now? I think students are still submitting. Okay, let us look at the answer. The correct answer is absolutely B, right? So many B answer this time we have seen. To provide investor with the information on how the risk are managed, right? That is the correct answer. So here we have ended the first presentation, right? There is a one more presentation that I'm going to make, but I believe you will give me at least a 10-minute break time. So we'll resume the second presentation after 10 minutes. Students, I believe you are there and I am again audible. I am resharing my screen. I discontinued sharing earlier when we completed the presentation. I believe our screen is now completely visible to all of you. And yeah, I have also unmuted myself. So I believe I'm audible to all of you. Ashura, are you there? Students, are you there? I'm audible to all of you.
Yes, sir.
Okay.
Yes, sir.
Okay. Okay. Thank you for responding. I think we'll wait for 1 or 2 more minutes and immediately after that we'll start because I said 10 minutes and I came earlier to that. So let us wait for 1 more minute. I think we had 52 participants earlier. Now we have only 45. So maybe we are waiting for 6, 7 more participants to join. Oh, even 2 participants reduced. Okay, better we join now. Right. Okay. In the previous presentation, we have understood how exactly one can measure the performance of mutual fund. Right. There are different category of mutual fund and what are the parameter, what are the factors we need to consider when we are measuring one performance of one mutual fund with different mutual fund. In this presentation, we are going to understand how exactly one can measure the risk and return on mutual fund investment. In the previous presentation, we also understood there are different type and category of risk associated when we look at to investing into categories such as mutual fund or equity market. In this slide, in this presentation, we are going to understand more detail about different parameter of risk and return. One, we can see the measures of return, right? A simple measure of return, we can say, for example, that if I have invested in 15 rupees and now my stock price is, for example, 20 rupees, I can calculate the difference between the purchase price plus all the taxes and everything and the price difference that I have right now, right? Though I haven't booked the profit so far, right? I haven't booked the profit. I'm just comparing the return. One is called as a simple return. Second is an annualized return. Third is a compounded return, right? Next is based on CAGR. Next is SEBI norms regarding representation of the return by mutual fund in India. So what SEBI norms are came up particularly for the mutual funds that we are going to understand. Risk of investing in different kind of funds, measures of risk, getting or restricting the redemption in the mutual fund, right? Segregated portfolio or side pocketing and risk associated with the segregated portfolio. So these are the main topics that we are going to cover up in our presentation. Let us start with the first point. Measures of return, right? How one can measure the return. Return from an investment which are calculated by comparing the cost paid to acquire the asset, right? It is also known as the outflow or the starting value of the investment to what is earned from it, right? That is called as an inflow and computing the rate of return. There are several methods, even we can use it on the Excel to calculate the different types of return. Some templates are also ready-made available. If you search for the template, then you can find some ready-made template. You just need to fit the prices and you can compute. The inflow can be from periodic payouts such as interest from fixed income securities and dividends from equity investment and gain or losses from changing the value of investment. Third point says the calculation of return for a period will take both into account. That means the income earned and gain or losses into consideration even in the gain or loss which has not been realized. Realized, that means the prices are right now down than our purchase value. However, we haven't booked the profit or losses at this point of time. But in our books of account, when we look at our debit account, we can see that the prices are lower compared to the price that we have purchased. So these are the popular mechanism to determine the returns. Very simple structured examples that we have put here in the slides, and I'm sure that let it be your any background, you would be able to understand all the rest of the price and calculation. Here some assumption is provided. For example, you invested in a scheme at a NAV of 12 rupees, right? NAV, that means net asset value of any particular mutual fund is 12 rupees. That means 12 rupees you need to pay to purchase one particular unit, right? You found that the NAV has grown to 15 rupees. So from 12 rupees to the price increased to 15 rupees. How much is the return? So the simple formula that we have discussed when we started discussion of this chapter, that the price difference. So what we are doing, 15 rupees minus 12 rupees multiplied by 100 divided by 12. So we can say that we have right now 25% return. Thus, the simple return says that the change in value of investment over a period of time. So this is the simple return we have calculated here. I hope you have understood. And if you find difficulty or questions at any point of time, you can immediately ask me. Look at the difference between annualized return. Two investment options that have been indicated their returns since the inception, that is 5% and 3%. So you are referring to one particular mutual fund and you see that since the inception, this is the return that they have incorporated. So one is 5% and second is 3%. If the first investment that was existence for 6 months and the second which is existed for 4 months, then the two returns are obviously not comparable. However, in annualization method, we can find out to compare these two return of different period. So you can see the simple return multiplied by 12 divided by period of simple return. That means what is the period that we were holding? We need to divide. So by this method, even if both are different funds, we still can compare using the annualized return method. This is a very simple method to compare, and this is a very powerful method. Using this method, we can easily determine the performance of two funds and even the risk factor associated with the funds. Third is a compounded annual growth. CAGR calculation, right? We are going to account here compound annual growth rate is considered based on the assumption that the dividend would be reinvested. Now remember, dividend is going to reinvested only in the growth fund. That means the fund that you are doing, the fund you are investing, particular mutual fund is a growth fund. So growth fund, that means dividend distribution is not usually happen by the company. Rather, what they do, whatever dividend they are about to distribute, they are going to accumulate that into the NAV prices, and the NAV prices is going to go up. For this kind of fund, CAGR, here we need to consider, is equal to ending value of particular fund divided by the book value, beginning value of particular fund raised to 1 divided by number of period that we are accounted minus 1 multiplied by 100. Even you can directly put down this formula into Excel and you can quickly find out. The template that I was talking about earlier, the template has a, all this kind of mechanism and you can easily find it out, right? And even you can directly copy and paste this and you can fit this. This formula is also available in the free booklet that is offered by the NISM, right? So you can easily find it out. You can put it in the Excel, give the formula tab, and after that you just need to replace it with the figures. SEBI norm says that mutual fund are not permitted to promise any return, right? This we have already foreseen in the first presentation. So this slide is repeated. So SEBI says there are no guarantee can be offered by any particular fund. If it's so, in that case, information document, it has to mention with the name of guarantor that this is guaranteed by so and so person, that this mutual fund, if you are investing, then this is going to provide this particular return. Okay, we continue here. There are multiple parameters that you can consider to measure the risk. The one popular parameter, variance method, even variance method you can measure even with the Excel. The best part is you don't need to be any expert or super special or to do all this computation. These are so much easy calculation and you can easily do it by your own, right? Variance measure that indicates the fluctuation between the periodic return of a scheme, which is compared to the on coverage return. Second, standard deviation. There are multiple standard deviation that you can compute in the Excel using the values, considering the mean return. You can compute the standard deviation. So here standard deviation you need to consider for the mean standard deviation. So you can keep in mind that is also measure fluctuation of periodic returns of a scheme in relation to its own average return. Mathematically, standard deviation is equal to the square root of the variance, right? That is very general formula. You might have studied this in a school even. Now, what exactly is the standard deviation? When you compare two standard deviation, it means that let us say, for example, standard deviation for one fund is just for assumption, let it be 5, right? And for another fund, standard deviation is, let us say, 7.5. It means that the prices of that particular NAV has a motive to move from its mean up to 7.5% either side, right? So this is how you can interpret, how you can go with the standard deviation. For the beta, which is based on the CAPM model, capital asset pricing model, it indicates that there are two kind of risk in the investing equity. One is systematic and second one is non-systematic. And only systematic risk can be measured by the beta. Non-systematic risk, you need to implement several other methods. And modified duration that measures the sensitivity value of the debt security to change in the interest rate, right? Higher the modified duration, it means that there is a higher in the interest rate sensitivity risk in the debt portfolio. Similarly, when you see there is a lower interest risk, that means the sensitivity risk in portfolio is lower. It means that the professional investor would rely on the modified duration as a better measure of sensitivity to interest rate changes. So the moment you identify the modified duration, you can identify whether any particular fund prices are correlated with the movement and changes of the mutual interest rate or not, that you can easily determine. So if you identify there is a strong correlation between these two, that means you also need to account the interest rate fluctuation and the volatility into interest rate when you are measuring the risk in the NAV prices. Restriction in the mutual fund. So according to SEBI, such restriction may be imposed only for a specified period, not exceeding to 10 working days in any 90 days period, right? And second is any imposition of restriction would require specific approval of board of AMC and trust. Most of the mutual fund, that are being handled by the trust. And the same is required to inform to SEBI immediately. As and when they come up with the decision, they need to immediately intimate to SEBI. And you can also find this news immediately going to announce on the MP website. Segregated portfolio, three part is mentioned here. Segregated portfolio, main portfolio, and credit rating agency. Please go through this content quickly. Segregated portfolio, that means we have seen that when most of the investment is specifically secured in one instrument only, they are not inviting any other instrument. On the other way, when you are comprising the portfolio, you are incorporating investment in shares, you are incorporating investment in debt market, you are incorporating investment in money market, right? So when you are investing such kind of portfolio, 100% the portfolio is going to strongly associated with the interest rate and the price movement and entire scenario, right? So that is called as a segregated scheme. Main portfolio, that means the scheme portfolio, excluding the segregated portfolio. Main scheme, that means you might have been aware with the different name of mutual fund, like growth fund, this fund, and where you even have an option to choose that you wanted to choose a fund where 30% investment is in a equity, 70% investment in equity, 80% investment in equity, right? So these options are there. So it is going to be the main portfolio, that means for which the SID is released. An AMC, asset management company, which allowed to create segregated portfolio in a mutual fund scheme in case where credit events at issuer level, that means downgrade the credit rating by the SEBI registered and other credit rating agencies. So that too also directly impact. Risk associated with segregated portfolio. One, investor holding units of segregated portfolio may not able to liquidate their holding till the time of recovery of money from the issuer. Second, securities comprising segregated portfolio may not realize any value. And third one is listing of units of segregated portfolio in recognized stock exchange does not necessarily guarantee their liquidity, right? Let me bring up the pointer here. There may not be active trading of unit in the stock market, and further trading price of the unit on the stock market may be significantly lower than the prevailing of NAV. So in which situation? During the segregated portfolio, because investments are diversified and not necessary that immediately at 3 p.m. as per the standard norms you are going to find out NAV. No, you are not going to find out NAV immediately in next 24 hours. So this was the point that I could incorporate here. And here, very simple questions are provided here. I'm going to open this chat box. Let us see how many of you are participating. Okay. Oh, I see one question. Is it mean that a beta of debt, sir? It means it is a beta of not beta of debt security, beta of equities, right? Beta of equities or any particular stock where the mutual fund is intending to invest. Even you can see the mutual fund portfolio that where they have diversified their investment. Look at the first question here. Let us see who is responding first. The formula to calculate the simple return. Okay, Partha said it is option A. Dhruva said C. Chaitan said again A. Ritesh also agreed A. Initial slide, I hope you remember. Priyanshi said it is A. Okay, okay, Priyanshi. Okay, let us look at the answer. The correct answer is A. That means the letter value minus initial value. Letter value, that means the current price minus the price that we have invested divided by initial value. That is the first formula, right? So we see most of the answers are correct. Let us look at the question number 2. Let me move out this checkbox here. Okay. Go to the question and see who is answering first. I think Priyanshi, no, she has responded earlier, right? Yeah, earlier, not for this question. And here we received the answer. First answer from Parth. Okay. How can one compare the returns of two investment option with different holding period? First option is by calculating the simple return. Second, by calculating the annualized return, right? Remember the question carefully. One can compare return of two investment options. Third, by calculating the compounded annual growth rate. And fourth is by calculating the variance. So let us see. The correct answer is B, by calculating the annualized return. You remember we go through the example where one portfolio return was 5% and the other portfolio return was 3%. For the duration of these two different funds were different. So for that, we have used the annualized return to measure the performance. I think you can answer these questions quickly. And the correct answer here is, oh, C is the correct answer, Partha. Or this is for earlier question, right? Yeah, this is earlier question. I think we haven't received any response so far. Huh? Yeah, Satyam said it's first answer. Satyam said it's a C. Right? Priyanshi is agreed with A. Even Guvada is also said it is option A. Okay. Ashish says C. Okay, Ashish. Partha is agreed with C. You think first option is correct? Have we used the minus formula ever? Okay, let us check the answer itself. The answer is C, which is absolutely correct. CAGR is equal to EV. That means, can anyone remember what is EV here? Let us check it out. And what is BV here? Ending value. Yeah, absolutely correct. It is the end value. And what is BV? Beginning value. Yes. And N here is for N. N is for, yeah, absolutely. N is for the number of years. Yeah, you remember the formula. Excellent. Let us see if we have more questions here. Yeah, one more question is there. You remember one only question was there about the SEBI norms? Chavi, 5 working days was there or 10? Remember there is only one slide. Oh, 15 also there. Partha is saying 15 days. Only one slide, you remember only one slide where the SEBI norms is associated with the maximum period. And that was the 10 working days, right? In 10 working days, what 10 working days? We just have, 3, 4 slide earlier only we have seen this, right? Okay. Okay, one more question we still have. What is the purpose of creating a segregated portfolio in a mutual fund scheme? And here the answer we have received is C, to segregate the risky asset from the main portfolio, but the answer is to separate the underperforming asset from the main portfolio. Now, only one answer correct. As Satyam said, it is a B answer, right? Only one correct answer. Okay, let us see. Last question. Maybe we still have one more question to go. You are not reading question properly. Eh? What is the main portfolio in a mutual fund scheme with a segregated portfolio? I think so far no answers. Oh, Chetan said first answer. It is a B. Satyam and Samyak is also B. Satyam says it's a D. Guvada is B. I think where are other students? Where is Priyanshi, Partha? They are not, participating in the quiz. Partha said D. Chavi says C. Ritesh is participated now. Ritesh said it's a B answer, and let us check it out. The correct answer is B, absolutely. The portfolio excluding the segregated asset. Right. You remember in the bracket it was written when we have seen this slide. Utkarsh is now saying it's a B, correct. So we know that in that slide, it was mentioned clearly into bracket that main portfolio, that means portfolio excluding the segregated asset. And to understand that, we say that it is the same portfolio which is mentioned in the SID, scheme information document. Yeah, one question that I told you. What is the primary measure of risk in debt mutual fund scheme? Okay. Parth is the first one. It is the D. And the correct answer is D only, right? Because when we refer to the modified duration, we are going to find out that whether the fund or scheme is associated with the movement of interest rate or not, right? So that is the reason modified duration is considered as a primary factor here. And last question, which of the following is not a measure of risk? Yeah, Satyam is the first one. Oh, Satyam and yeah, good. A standard deviation is a measure of risk, right? Standard deviation is a measure of risk. The correct answer here is Sharpe ratio, right? Sharpe ratio is a performance measure and not a risk measure. Two ratios, Sharpe ratio and train ratio, are considered as a performance measure and not a risk measure, whereas variance, standard deviation, and beta are considered as a measure of risk. According to the SEBI norms, what is the maximum period for which a mutual fund can create a segregated portfolio? 60 days, 90 days, 120 days, or there is no such limit specified by SEBI? One brief discussion was there. I think Chaitanya said B answer, D answer, B, two response. Yashwant has participated now. He says it's a C. Right. You remember one description was there. Only two norms were released by SEBI. One, oh, then Bandaru, I think he is now active. He has participated. Right. Ganesh. Okay. The correct answer here is D. Because you remember there was one slide that whenever such kind of changes happen, they have to immediately inform SEBI. So no time limit were provided here. Whenever the board and trust takes the decision about create a segregated portfolio, they immediately need to intimate the SEBI in this regard, right? So there are no time duration that whenever they take up with the decision, they need to immediately intimate to the SEBI, right? So time duration was not there. What is the primary risk associated with holding unit of a segregated portfolio? inability to liquidate the holding. Second, potential loss of the principal. Third, volatility in the NAV, and all of above. Right. So absolutely, the answer here is D only, all of above, right? And all the answer, I think this is the only question where all the answers submitted by all you students are absolutely correct, right? So this was the end of this presentation. So in the first presentation, we have understood about the performance measure. And in this second presentation, we have understood about the risk and return measure in the mutual fund, right? I'm closing this here. Now there is only one part left for you to explain, risk hierarchy. This is relatively very small slide, so I'm going to start this. Risk hierarchy in mutual fund schemes, right? The way we are understanding this content, first we have understood how to measure the performance of different mutual fund. In the second part, we have understood how to measure and identify different risks and different returns in particular mutual fund. And now, when we identify different risk and return in different mutual fund, we need to give risk hierarchy. And this actually increases our deep understanding when we understand the risk hierarchy associated with different mutual fund scheme, particularly when we are comparing the performance of one mutual fund with the another mutual fund. In this small presentation, we are going to cover up risk return hierarchy in debt market, credit risk in debt market, risk return hierarchy in equity mutual fund, and hierarchy in hybrid funds, right? When multiple funds, multiple investment fund are accumulated at one particular portfolio, called as a hybrid fund, and SEBI's riskometer, right? So these are the points that we are going to learn here. Start with the first point, risk level in mutual fund scheme. Look at the description. In order to evaluate and select various mutual fund scheme, it is important to take a look into the risk return profile of the various scheme categories. As one moves from liquid funds to debt funds to hybrid funds or to equity funds, the potential returns as well as the investment risk increases. Broadly, one can say that moving from left to right as the risk as well as the potential return would go up, right? But on the other hand, if you have look at the one popular risk measure called as a value at risk, you might have seen that the value at risk graph comes in the bracket of last 5% at the left side. Okay, let me show you that, right? Since this is an online class, I can show you that how it goes. So value at risk, right? So let me show you the image. Let us go to the image. So look at this image. Why it is not opening? Yeah, it is opening. I hope you can see the screen, right? You can see that here. This is better. Oh, where is that? You can see it here. The moment it goes to the left side, you can see this 5% quantile of this part, red area. Can you see this? This is considered as the strongest risk measurement technique. And there are four category in the value of risk, right? So more it comes to, so this parameter is identified to understand that what is the, if anything extreme happen to the prices of the stock that I have invested, what is the probability that the maximum can happen on any given day? And to determine that, this model is being used, right? There are four category of this model. Okay. I don't know whether I would be able to write here. I'll write it here. One is called as a standard value at risk. Second is called as a historical value at risk. Third is called as a conditional value at risk. It is also known as a CVAR. And fourth one is called as a this four category, and it is so simple. If you learn this four category measure of risk, and you can perform this on a simple Excel file, right? You wouldn't believe you can determine the most hidden information in any particular price movement, and this is considered as a powerful movement. So whenever you are at the agenda to measure the different scheme, you just pick up the prices, historical prices that you see on the listed in the NAV, and you just paste that prices on the Excel to build up such kind of model. Out of this four bar that we have just seen earlier, the most important parameter here is defined by the conditional value at risk. And it says that in no case the price is going to breach the conditional value, right? So let us say a standard VAR is 2%, historical VAR is 2.5%, conditional VAR is 3.2%, and Monte Carlo VAR is, let us say, 2.8%. So here it means whatever parameter is provided by 3.4% for conditional VAR. Let me write down it here, so because you won't be able to remember everything. Let us say 2.6% is right. And this VAR is, let us say, 2.85%. So the belief is what they do, even entire FII, DII, mutual fund industry, they check this conditional VAR parameter, and they find out the distance between standard VAR and conditional VAR. This parameter helps them to decide that what would be the stop loss, right? So this is something more than the mutual fund, but I am bringing it up here so that it may increase value to your understanding when it comes to the risk assessment. And it says that if this value of 3.4% says that any company stock, and if you are calculating the VAR, Monte Carlo simulated VAR gives you the real-time VAR. If the prices are live, you can feed the live prices and you can match out you can bring up the VAR. So this value says that in no scenario, prices of that particular stock will go down more than 3.4% on any given day. Right. So this is how I use this parameter to bring out the circuit, what we can say, stop loss limit and sell out limit. Okay. We go back to original slide. Okay. Let me bring out the pointer. Risk return hierarchy in debt fund. So one is called as a overnight fund. Then it goes to the liquid fund, ultra short duration fund, right? The duration for the investment fund is very less period of time, and low duration fund. On the other hand, you can see here from short duration fund to medium duration fund, medium to long duration fund, and from long duration fund to a medium to long duration fund to long duration fund, right? So maybe you can consider any kind of what we can say ELSS type of fund where investment is at least for 3 year and more period of time. Even in the growth fund, people invest for 10 year, 15 year, that kind of duration, and it keep continue increasing the value of the NAV over a period of time, right? And most of this fund definitely includes the debt funds. In the debt fund, you can look at the yield funds, right? Most of funds which are investing into the government bonds only, banking and PSU funds, right? Corporate bond funds, investment. Remember, investment are still into the bond, still into the debt market, but the instrument of debt market, it either be from the government, issued by the government, state, maybe central government, banking sector and public sector unit also come up with such kind of fund. Other corporate unit also come up with the fund and credit risk fund, right? So these are the hierarchy. Look at here. In the risk return hierarchy, how it increases. This parameter shows the low risk, which is associated from small cap funds. And the moment you go to the large cap funds, you can see the risk parameter is increased here over a period of time. So from small cap to mid cap to multi cap fund, multi cap to large and mid cap fund, and from large and mid cap fund to large cap funds. Explanation says that smaller companies are riskier than the larger counterparts. We have seen in the example earlier that the price movement in small companies is relatively higher. And hence, small cap funds carry high risk from mid cap funds, which can turn are riskier than the large cap funds. In the similar manner, a concentrated portfolio is riskier than the more diverse fund. That means diversified risk to focus fund risk and focus fund to thematic fund, and then it comes to sector fund. So this makes even more riskier, and the less riskier is the diversified funds. Then in hybrid fund, you look at the segregation from arbitrage fund to equity saving fund, from equity saving to conservative hybrid fund, from conservative hybrid to dynamic asset allocation fund, and from this to multi-asset allocation, from multi-asset to balanced hybrid fund, and from balanced hybrid fund to aggressive hybrid fund, right? So here the risk factor is the highest, and in arbitrage fund, the risk factor is lowest. The SEBI product labeling on mutual fund riskometer says, first comes the parameter in the riskometer is the low risk, right? Which associated here, that comes with the hybrid fund or diversified portfolio, always comes with the low risk. Remember, when we say that the risk parameter is lower, it means that the return is also very much lower. There is a particular instrument, let us say if you are investing entire amount in let us say fixed deposit or post office saving fund, you know that there is no risk on the lose of your capital. But then you are going to compare that if the inflation, rise of the inflation is higher than the interest which is being offered by the fixed deposit or bank, statistically you are in the loss, right? Okay. Then second comes the low to moderate risk. Third shows the moderate risk parameter that comes here. Then moderate to high risk parameter here, which shows the balanced fund. Whenever we say that we invested into the balanced fund, that means it point out set here at number 4. High risk, that means there are chances that the NAV may fluctuate higher, right? And very high, that means if one is investing large amount in exclusive portfolio instead of diversified portfolio, what happens? The risk becomes very high, right? One URL is being pasted here. If you click on this URL, you directly redirect to the same document from this content is derived. That is on our SEBI website. So as I mentioned, this was the small part that I was intending to cover up, and with a few question, of course. First one is, as per the risk return hierarchy. Oh, let me open this chat box. Uh, where is that? Oh, let us see who is answering the first. So far, no risk. Yeah, Partha is very active and responded to first. He says A is the first answer. Overnight fund. As per the risk return hierarchy depth fund, which fund has the lowest risk? Yes, I think it is unbiased answer. I think all students is going to answer A, right? Because it is overnight fund, and since the investment is overnight, there is no risk, right? Yeah, Ashish, absolutely correct answer. Utkarsh and Parth, very good. The answer are correct. Look at the second question then. Partha says B. Ashish, Utkarsh, Priyanka, all you are there. Chavi is B. Panav is A. Ganesh says A. Then Yashwant Kuwadai, Yashwant says B. Okay, so you think that the hierarchy of credit in debt market, which type of fund has a highest credit risk? Corporate credit risk fund, guild fund, overnight fund. So overnight is a straight incorrect answer. We know that. Let us look at the answer then. The answer is credit risk fund. And I believe most of the answer, I think this is again one question. Finally, where most of the students have responded all the students responded the correct answer. Very good. Very good to all of you. Look at this third question. This is equity fund, okay? And we skip this slide quickly. So let us say how much you remember. Partha says C. Oh, Ashish also, no, Ashish earlier answer, right? Utkarsh also C. Ganesh A. The correct answer here is C, right? So Chavi, Utkarsh, Parth all submitted the correct answer. Sector funds is the riskiest, right? You remember just before we entered into this question, we said we are investing into diversified funds, it is the most lowest risk, and when we are investing in exclusive sector specific funds, it is the most riskiest fund. Question number 4. In the risk return hierarchy of hybrid funds, which type of fund is considered the most conservative? And answer, I think, yeah, Partha, I think, is the first one. Ganesh, I think you are responded for the earlier question, right? Or you are responding for this question? Ritesh A, Ganesh B. Yeah, Ganesh has submitted answer now. Yashwant is C. See, only we can see hardly 7, 8 very active students. I'm so happy to see your participation here. So to participate in such kind of activity is very, very important. So I'm very happy to see your participation here. Let us look at the option: multi-asset allocation fund. Second, conservative hybrid fund. Third, aggressive hybrid fund. You remember we had one slide, hybrid to aggressive hybrid fund and equity saving scheme. So the correct answer here is B. Right. So I think B answer is given by Ganesh. Then Ganesh, very good Ganesh. Partha is no. Very, very active. Partha, Ganesh. Ashish is not submitting answers so far now. Okay. That is all. I was expecting one more question but because earlier we had eight questions and 10 questions, and in this slide we had only 4 questions. Okay. So I think this is all that I had intended to educate you. I ran through 3 different presentations. In the first presentation, we have understood about the performance measurement of different schemes, in which we have gone through the different parameters by which we can understand that what parameter is determined and how we can evaluate the performance of fund. It was very elaborative discussion in the first presentation. Then we came into the second presentation. In the second presentation, we have discussed about how exactly we can evaluate the risk and return and what methods we can use to determine different risk and return parameter considering the different scheme of funds. So that we have understood. We also understood with some illustration and example that if the purchase price is this much, selling price is this much, how to determine the return. And in this particular presentation, we understood different risk hierarchy as per the SEBI norms, that how we can determine. And we can conclude here that when we are investing into funds which is a overnight, that is the lowest risk, right? Merely no risk compared to the long run investment fund such as growth investment fund and like that. Similarly, when the investment we are making into the um, diversified portfolio, when we are coming up with the diversified portfolio, that means we are diversifying the risk compared to when we are making the portfolio of a selective fund or segregated funds into one particular sector-wise portfolio, where the risk is extreme highest, right? So this is how we understood the risk hierarchy in debt fund, in equity fund, right, into different instruments. So that was all the agenda for the presentation. And now I can take up all the questions that you have to, ask, you have reserved for me. I'll try to address questions with my capacity of understanding. So I'm closing this slide. I'm putting down these names into the chat box. So if at all you wanted to learn more, you can use this, right? I'm pasting it here. Right? So you can use these names, and even there are wonderful videos. If I would have, more time or better opportunity, I would have actually taught you this how to calculation of the risk. So maybe some other time, if I'm lucky and if I have opportunity, I'm definitely going to lead you through that explanation in depth detail. Okay, I can take up your questions now. I think I'm leaving you only 9 minutes for question and answer. I hope it is a sufficient time. I'm closing this presentation. Yeah. Uh, how can yeah. Ashutosh, I am sharing my screen. Am I already sharing my screen?
Yes, sir. Your screen is shared. Value at risk, I can see.
Okay.
Images from the Google.
Okay. Okay, now I can take up questions. Right. And let us see you can put question in the chat box. They can unmute themselves, Ashutosh.
Half of them are already unmuted, sir. They can unmute and speak. And if
Okay.
anybody raise hand, I will unmute them.
Okay. 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 Let us see who is asking question.
If you have to ask question, unmute yourself. Sorry, raise your hand. I will unmute.
Please raise your hand, those who have a question to ask me, so that Ashutosh is going on unmute you.
I think they are hurry to lunch. Anybody has any
No,
question?
that not be the
Parth
reason.
is asking something.
Yeah. Parth is asking a question, sir. Is there any other performance measure ratio than Sharpe ratio and Taylor ratio as Jones? Yeah, there are many other things. See, when we are comparing the performance, there are several parameters that we can bring into account. So, of course, you are correct. We can consider Johnson's alpha. We can consider Cronbench alpha, right? So many other parameter we can consider when we are measuring the performance of any particular portfolio. Maybe the list goes more than 10 different ratio parameter, and there are, when you use advanced tools and advanced models, you also have even more deeper insight, right? Partha, whether I addressed your question? Parth? Ashutosh, you are on mute.
Parth, you can unmute and speak if you want. I think he believes in typing.
Oh, okay, Parth. For your second question, if you want to start mutual fund research, then from where it can, okay, you can start. See, mutual fund research is a separate thing. Mutual fund is a separate thing. But to start a research, just fetch up the data on the NFI website. What you can do, you can copy the data and you can paste that data on the Excel format. And as I have mentioned, there are several YouTube videos, some methods even being explained very well in our SEBI NISM booklet that you can freely download. You just need to convert that formula into the Excel. You can put it out and you can just simply run all these historical prices through the filtering to this different formula, and you will start learning. And more you search about the advanced tools and techniques, there are several YouTube video also, you can find it out. Based on that, you can learn that how exactly you can interpret the prices. But so far it is going to be a very open research. There is nothing that for mutual fund you need to do something different. So you can even select sometimes any equity or any companies, any stock prices to interpret and assess. So you can start with that. I believe, Ashutosh, now Parth has no more question, and I think no other student has any questions. So with
Yes,
that,
sir.
I would like to
So thank
conclude
you,
my
sir. Thank you
presentation
so
here.
much for taking the lecture and giving time to our dearest students from the different part of our country. And thank you, dearest students. Please send your feedback with more topics where you want to learn, and we will conduct such kind of sessions in the future. And Dr. Jatin Trivedi, sir, will be there in future sessions also. So thank you so much, sir. With your permission, we are concluding the session.
Okay. Okay.
Yeah.
Thank you, Ashutosh. Thank you all the students for joining us and listening to me patiently. Wish you all the best, and you can reach out to me at any point of time. Thank you.
Thank you. Thank you, everyone. Team ITD, please stop the recording and conclude the session. You may leave, sir. They will do the need.